Chris here from Project Option, and in this video we're going to talk about trading VIX futures. Now this isn't an options related segment, but I still think understanding VIX futures is important because if you don't understand how VIX futures mechanics work, you could find yourself in a lot of trouble. So that's the goal of this video, is to just keep you informed and protect you from making costly mistakes. Alright, so what are VIX futures? Well, the VIX Index is an index that tracks the 30-day implied volatility of SPX options. However, the VIX Index is just an index and it cannot be traded directly, but VIX futures were introduced in 2004 as a means to gaining exposure to changes in the VIX Index. So VIX futures are just a vehicle that traders use to trade changes in implied volatility. So this graph here is just a demonstration showing you how a VIX future tracks changes in the VIX index. Now it doesn't track it point for point, but it does tend to change in the same direction as the VIX index, especially when that VIX future has an upcoming settlement date. So before getting into the details, let's talk about the basic contract characteristics of a VIX future. So the VIX future contract name is VX, and the contract multiplier is 1,000. So that means every point in a VIX future translates to a dollar value of $1,000. So for example, if you buy a VIX future for 15 and sell it at 16, that's a $1,000 profit. On the other hand, if you buy a VIX future at 20 and sell it for 15, that represents a $5,000 loss. So each point in the VIX futures contract represents a notional value of $1,000. Now the minimum tick value of a VIX futures contract is 5 cents. Now multiplying that 5 cents by the contract multiplier of $1,000 gives us a value of $50 per tick. So the slippage cost of just getting in and out of a VIX futures contract when buying at the ask and selling at the bid is $50. So let's say the asking price of a VIX futures contract is $15.05 and the bid is one minimum tick lower at 15. So if you buy that VIX future for $15.05 and sell it for 15, you just lost $50 just getting in and out of the trade. So keep in mind that the slippage cost of getting into and out of VIX futures contract is very expensive. Next, the settlement value of a VIX futures contract is VRO, which is a special opening quotation that uses a VIX-style calculation on the morning of VIX settlement. Now, there are weekly VIX futures contracts available as they were recently introduced, but they're not yet that liquid. So I would not recommend trading the weekly VIX futures contracts until the open interest and volume picks up in those. So if you are going to trade a VIX future, you're probably better off staying in the standard monthly contracts that correspond to the standard VIX option settlement dates. And lastly, VIX options are priced through supply and demand. So unlike the VIX index, which is calculated, VIX futures are priced based off of supply and demand in the marketplace. So there are a few things you need to know before trading VIX futures contracts if you trade them at all. So the first is that longer term contracts typically have more carrying costs than short term contracts, which we'll talk about in the next slides. And second, as each contract settlement date approaches, the value of the contract will converge to the VIX index. So let's go ahead and walk through each of those points with some examples. So let's start with carrying costs when the VIX futures curve is in contango. Now, contango is when longer-term VIX futures contracts are trading at a premium to shorter-term VIX futures contracts. So if we look at the very first point on this graph, we can see that the VIX index is around 13. The April VIX future is above 15, the May VIX future is above 17, and the June VIX future is about 18. So as we go to longer VIX futures maturities, the VIX futures contracts are more expensive. Now that is referred to as contango. So as each contract settlement date approaches, the contracts will converge to the VIX index. So if that VIX future stays at, or if the VIX index stays at 13, all of those contracts will converge to 13 as their settlement date approaches. Now I said before that longer term contracts typically have higher carrying costs. So if we look at this, if you bought the April VIX future for 15 and it converged to the VIX index at 13, you would lose 2 points on that VIX futures contract. Now, if you instead bought the June VIX futures contract for 18, you would lose 5 points on that contract as it converged to 13. So, if you're buying longer term VIX futures contracts when volatility is low, just know that if volatility does not increase, your loss will be greater than if you had bought a more near term VIX futures contract. Now, in this particular example, the VIX index actually did spike near the end of the period. So if you did buy that June VIX futures contract for 18 in the beginning of the period, you actually did make a point and a half because that VIX futures contract settled to a value around 19 and a half in June. However, if you look at the VIX index and the value of the June VIX future right before that big spike, you'll see that the VIX index was trading between 13 and 14, while the VIX future that settles in June was trading between 14 and 15. So just know that if you buy a VIX future when volatility is low, you're essentially saying that you believe the VIX index will rise to a value greater than your VIX futures purchase price by the time the VIX future settles. So to build on that last point, let's consider some potential losses from buying VIX futures when the futures are in contango. So when the longer term VIX futures contracts are more expensive than the near term VIX futures contracts. So let's say the VIX index is currently at 1310, and let's say the April VIX future is at 1542. If you buy that April VIX future at 1542, you'll lose $2,320 if the VIX index remains at 1310 through the April VIX futures settlement. And that's because the April VIX future that you purchased is $2.32 above the VIX index. And since the contract multiplier for a VIX future is $1,000, you'll lose $2,320. Now, if you buy the June VIX future at 1804, that future is $4.94 above the VIX index value of 1310. So if the VIX index stays at 1310 and you bought that June VIX future at 1804, you'll lose $4,940 from the convergence of that VIX future to the VIX index through its settlement in June. So in other words, if you buy that June VIX future at 1804, you're essentially saying you believe the VIX index will be higher than 1804 by the time the June VIX settlement approaches. Now let's look at the VIX futures carrying costs when the curve is in backwardation. Now backwardation means that near-term VIX futures contracts are more expensive than longer-term VIX futures contracts. Now, backwardation typically occurs when market volatility is extremely high because people expect volatility to come down at some point in the future, and therefore the VIX futures with longer maturities will trade at lower and lower prices. So, when the VIX futures are in backwardation, the sellers of VIX futures actually experience losses if the VIX index does not fall, which means the carrying costs are now pushed onto the VIX futures sellers. Now the carrying costs are pushed onto the seller when the curve is in backwardation because if the VIX index remains high, each VIX futures contract is going to appreciate in value as their settlement dates approach. So let's go ahead and calculate the potential losses from selling VIX futures when the futures are in backwardation. So let's say the VIX index is at 5513 and you want to sell the October VIX future for 4909 because you think the VIX index will be below 4909 by the time the October settlement approaches. So since that October VIX future is $6.04 below the VIX index, you'll have the potential to lose $6,040 if that VIX future converges to the VIX index. So in other words, if that VIX index stays right at 5513 through the October VIX future settlement, that October VIX future will go from 4909 to 5513. And since you're short that contract, you'll lose 6 points and 4 cents. And since the contract multiplier is 1,000, that 604 loss translates to a loss of $6,040. So where I'm going with all of this is that there's a cost associated with making the obvious volatility trade. Now, by obvious, I mean when volatility is extremely low, everyone wants to buy volatility because they expect it to expand eventually. And when volatility is extremely high, everyone wants to sell volatility because they expect it to come down eventually. So when you buy VIX futures when volatility is extremely low, the VIX futures curve is most likely in contango, which means those VIX futures are going to be converging to lower and lower prices if the VIX index does not rise. Now, since the VIX futures are converging to lower prices, that means buyers of VIX futures will incur steady losses. Now, on the other hand, when the VIX index is extremely high, the VIX futures curve is most likely in backwardation, which means if the VIX index remains high, those VIX futures are going to converge to higher and higher prices, causing losses for VIX futures sellers. So now you might be wondering, why don't you just sell VIX futures when the curve is in contango and buy VIX futures when the curve is in backwardation? Well, I'm sure some people do that, but here's the thing. When you sell VIX futures when they're in contango, you're selling VIX futures at a low price, which means if the VIX index spikes overnight from some, market catastrophe, those VIX futures could rise, 5, 10, 15 points overnight, in which case you'll lose multiple thousands of dollars. On the other hand, if the VIX index is at 60 and let's say you buy a VIX future for 55, if the VIX collapses like it tends to do when it's very high, that VIX future is also going to collapse. So if you buy a VIX future for 50 and you see it go to 40 in one day, you just lost $10,000. So the problem with selling VIX futures in contango and buying VIX futures in backwardation is that if volatility reverts to a more normal level, your losses could be substantial. Alright, so let's go over the summary of main concepts that you've learned from this video. So first, the contract multiplier of a single VIX futures contract is $1,000, which means a single point change in the contract's price translates to a profit or loss of $1,000. Next, the minimum tick value for a VIX futures contract is 5 cents, which translates to a profit or loss of $50 on one contract per tick. As time passes, VIX futures contracts will converge towards the VIX index, as well as become more sensitive to changes in the VIX index. When VIX futures prices are above the VIX index, buyers of volatility futures face losses as time passes if the VIX index does not increase. When VIX futures prices are below the VIX index, sellers of volatility futures face losses as time passes if the VIX index does not decrease. Well, that wraps up this video. I hope everybody learned something, and more importantly, I hope you learned things that will help you avoid making costly mistakes when trading VIX futures. If you enjoyed this video, please subscribe to our YouTube channel so that you get video alerts when we come out with new topics.